UPS is down 20% over the last 12 months, trading right there towards its 52-week low, and we have a buy rating from Wall Street, and this is a company with a nice forward yield of 4.74%. So is this one to strongly consider in our portfolio as an undervalued dividend stock? Well, in today's episode, we are also going to cover the significant partnership that they now have with USPS. We're going to cover that in some detail. We're also going to take a look at some insider buying as well as insider selling over the last year. And we'll also look towards the institutions. As always, are they buying or selling this in the more recent quarter? Fundamentally, we do want to look at not just their dividend safety, but some of their underlying supporting metrics, the likes of the free cash flow, their debt levels, their ROIC, and importantly, we want to see where is this company headed over the last 10 years. Do we see some nice growth, not just on the top line revenue, but also the bottom line net income, whilst also incorporating a very quick health check on the balance sheet, their total cash versus their total debt, and we'll look not just towards their competitors over the last 10 years, but also whether or not they have been outperforming the S&P 500, as you could argue, in fact, it might just be better to put your money into a low-cost ETF. Ultimately, we will get to the valuation model, understanding our intrinsic value, what is our acceptable buy price, incorporating that investor margin of safety, as well as considering Wall Street's forecast over the next year as well. So let's have a quick look at how this company has performed historically. And over the last year, as we mentioned, down 20%. Over the last 10 years, if you've been a shareholder, it has been a very poor return, only plus 34%. Bear in mind, if you reinvest dividends, it would be slightly higher. And we can see it is now somewhere way off that 52-week high of $193. Forward P though, very low in comparison to the S&P, 16.8 versus the S&P's 22, but we will consider essentially the forward P of others in this industry. A nice forward yield as well, 4.74%. So let's take a quick look then and understand some latest news. Now they do have now a significant partnership with the USPS. We're going to take a look at this momentarily to understand what this means for the company, as well as the numbers, their top line growth, as well as how this can go moving forwards. So what we can see, they are taking over from FedEx. As we can see, this was essentially a 20-year contract, so very long. And if this is something that also UPS can incorporate, then it could be very nice for their top line over the next few years and beyond. We can now see that their contract does run until September 2024, so this won't be affecting their top line numbers for a few months, so don't expect that to come up in any of their latest quarterly numbers. And what we can see that in terms of what the numbers meant for FedEx over the last 10 to 20 years, it was around 4% of their top line, around $2 billion USD. Now, we'll take a look at that and see how much of that percentage-wise will now take up UPS's to understand if it is a large or meaningful number. But this is quite interesting. They are now taking over this contract from FedEx, which, as we can see, was a very long time period as well, over 20 years. Now, what we can see, they are expecting a minimum term of around 5.5 years. So that is good to know that at least for the next 5 years, this will be around that $2 billion mark recurring revenue to their top line. Talking about their numbers then, let's go and have a quick look to see how UPS will be incorporating this moving forwards. So in 2014, $58 billion on their top line. As always, 3 to 7% baseline growth year on year. What we notice, they have nearly doubled that, $58 billion in 2014 to around $91 billion in 2023. And we also want to point out the drop, in fact, a massive 10% drop from 2022 to 2023. But over the longer term, we can in fact see there has been growth on their revenue, although we would argue inconsistent. And one thing we do want to point out, if their revenue is going to be roughly the same as FedEx's, around $2 billion year on year, we can see there's very minimal growth to their top line. But again, always getting new contracts is something very positive for a business, and hopefully they can continue to find other ways to increase their top line. But that is obviously a positive one to start off the episode with. In terms of their bottom line net income, well, in fact, they've doubled it over the last 10 years. $3 billion in 2014, $6.7 billion in December 2023, but a lot of inconsistencies, whereas with the top line revenue, we did see growth for the large part each year over the last 10 years. On the bottom line, very inconsistent. In fact, it grew massively from 2020 to 2021 before decreasing in the two subsequent years. So Top line looks good, bottom line very inconsistent, so do factor that in to your own investment thesis as well as your analysis. In terms of the health check, well, 3.3 billion in 2014, 4.5 billion in their latest report, so they do hold more cash, but again, similar to other points in this company, very inconsistent. We do know year-on-year movement can go from increases to decreases, and in fact from 2021, the next 2 years have been decreasing. Now, in reality, that doesn't really mean much on its own. That is why we always, in each episode, compare it both numerically and directionally to their total debt. What we notice is more than double the increase of that total debt, 10.8 billion in 2014, 24 billion in their latest report. And as we can see, the trend, whilst cash is fairly inconsistent, their total debt over the longer period has been increasing. And as always, this is also important to understand when we do later come on to that dividend safety to see whether or not they continue to increase those dividends and that yield as well, which we will discuss as we are a little bit disappointed with those increases in the more recent period. Now, in terms of their earnings per share, how have they performed? Well, actually a very solid track record. Last 4 quarters, they have in fact beaten analyst targets, so they're off to a great start. However, we want to point out the next quarter, they are anticipating double-digit decrease year on year to essentially the earnings per share, followed by some nice increases over the next 3 quarters. Now, if you're looking for December 2025 and beyond, the earnings estimate of 9.75 does lower their forward P to around 14.12. But as we're now about to come on, it is also important to understand not just against the S&P, because that can be a little bit irrelevant, but more to companies in the very same industry, how that compares. So the first thing we're looking at is the valuation grade, and they do get an overall B. Now, in terms of looking at specifics, so on a P non-GAAP basis, 16.79. So they are trading a discount to the sector of 18.66 by around 10%. If you do look at other metrics as well, we can see, for example, on a price to sales forward looking, they are trading at around a 13% discount. On a price to book, however, they are trading a lot higher. Now, it will come down to what metrics you look at. For example, those who do like to see on a price to cash flow, they are trading at a discount around 17%. On others, they are trading at a premium. That is why overall for this grade, they do get a B. One that we would look at for UPS, 16.79. It is lower than that sector medium. Now, in terms of looking at the growth grade, they get a D- pretty much across the board, so very poor, no surprises. Given just last year, their revenue is down 9%, with others mid-single digit up 5%. Forward looking, pretty much flat is the expectation, whilst others are seeing around 6.33%. And one thing that we do like to draw your attention to is that earnings per share over the next 3 to 5 years. 8.26%. What we can see here, sector median nearly 12%. So in fact, they are trading a lot lower, 30% lower than what we would expect for the next 5 years on the earnings per share. So not that great so far. Will the profitability help? Well, in fact, they get an A+ on this score. What we do know, however, their gross profit margin, 22%, is lower than the sector at 31%. Their bottom line only marginally higher, 6.6 versus 6.03. However, when we do take a look at their cash from operations, it is very strong, 11.2 billion versus 324 million of others in the sector. Now, overall, in terms of a conclusion for this part of the analysis, Wall Street, however, do consider this as a buy. Seeking Alpha and Hold Quant do give this a hold. Valuation aspect, a B. Growth, D-. Profitability, the one shining light there at an A+. Now, in terms of looking at how they compare against others in the industry, we're focusing on air freight and logistics, FedEx, Deutsche Post, as well as a few others. Now, this includes dividends reinvested. So UPS, as we can see, down 16%, pretty much one of the worst. If you want to do it in case of one of their close competitors, FedEx up 13% for the same period. Over the last 5 years, what we do note, however, UPS up 62%. Again, they are one of the worst performing. FedEx not too far off that at 69%. And if you want to see over the longer term, we do note UPS up 84%, FedEx up 92%. Now, if you're not getting over 100% return over the last 10-year period, then that isn't really a great investment in my personal opinion. But as always, past performance does not indicate anything about the future, just something that is good to see moving forwards. So now let's take a look very quickly at essentially comparing this to the S&P 500. What we can see, the S&P up around 24%, UPS over the same period down 16%. When we extend this over the last 5 years, UPS, it is up, but as we can see, only 62 versus the S&P up 86. And when we expand it over the last 10 years, we can see pretty much over the last year, 5 years and 10 years, the S&P quite clearly has outperformed UPS. Now do let me know whether or not this is something that you normally take into consideration, or maybe you personally just like to look at individual stocks and not really compare it against the S&P 500. Now one thing we want to point out, we have released our latest free weekly article, 12 undervalued dividend stocks, all high quality. If you want to gain access to this or any other articles, all completely free, do click on that pinned comment below. You can sign up and read straight away. How to find undervalued stocks as well, important if you want to see the resources and websites we use to find undervalued stocks that we typically buy. Now let's take a look at insider movement. Now we noticed the insider ownership fairly low at 0.13%. We have one insider selling nearly $4 million worth over the last 12 months, with one insider buying a very small amount in comparison, just under $200,000. And you have to go back to essentially Q1 to see the buying, and if you want to see the selling, you have to go all the way back to Q3. So in the more recent period, we do actually note in 2024 some insider buying. Now, in terms of who this insider was, well, what we can in fact see is that it was the director who did buy on the 2nd of February, 1,400 shares, around $142, not far off the current trading price, and as we can see the amount there. Whether or not you believe that is bullish, that is up to you to decide. The insider selling, though, is quite significantly later on in the last year or so, at around the 16th of August 23, so not something we would personally consider into our own investment analysis. To be fair as well, insider selling isn't something that we typically consider due to the fact that we don't know why insiders sell. It could be personal or it could be financial reasons. Now, in terms of institutional ownership, 60%, $7.44 billion worth of sales over the last 12 months. We do notice more buying over the same time period. However, what is interesting to note, Q1, the more recent quarter where we have the data, institutions have been selling more than they have been buying. When you look back at the previous quarter, though, we do see the opposite. So overall, for a conclusion in this, what we see is insiders buying over the last few months. However, with the institutions, they have been selling more in quarter one, but over the last 12-month period, they have been buying more. Important, though, to understand, never copy insiders or institutions and always do your own due diligence. Dividend safety score then 69. It does look to be safe. Market cap 118 billion. It is a mega cap company, and we can see just last month it was reaffirmed that the dividend safety of 69, and it means a dividend cut is unlikely. Now, in terms of key recessionary metrics, well, they maintained the dividend during the 07-09 Great Recession, didn't increase it, didn't cut it. They pretty much had average growth of that of the S&P around negative 12%, and they only marginally outperformed negative 48 with the S&P's negative 55. Dividend growth incredibly poor, 0.6% in January this year, pretty much just to keep up their streak. Over the last 5 years and the last 20 years, double digits, which makes it worse as to that increase this year, which was incredibly trivial. And we can see they have been increasing those dividends for the last 14 years, whilst also paying a dividend for the last 55 without a reduction. Now, in terms of dividend yield theory, it does say the company is undervalued when the current yield sits above the 5-year average, so we have one sign of severe undervaluation. On the forward P, marginally lower than the 5-year rolling, so you could argue another undervaluation signal. Just bear in mind that we're not looking at any of these models in isolation. We will conclude towards the end, and we can see the sector P for industrials does sit higher at 19.2, so again a triple undervaluation signal for United Parcel Service. In terms of the free cash flow payout, which is what we do focus on, below 60% is what we want to see to give us faith that management can offer those double-digit increases. Massive red flag in 2023, 110%, indicating that management paid out more in dividends than they generated in free cash flow. Remember, we do focus on this because it does show us potential upcoming dividend cuts, whereas the earnings data is susceptible to manipulation by management through accounting. 2024 estimated to be even higher, so for me, I would already say this is a red flag. This is a worry that they're expecting, not just in 2023, which they did, but also in 2024 that they're going to pay out more in dividends than they're going to generate in free cash flow. The free cash flow itself, as we can see, what we typically want, consistent increases over the longer term. It has increased, but very, very inconsistently with 1 year negative. 2024, as we can see, is expected to go lower, so do bear that in mind. Sales growth, as we said earlier, 3 to 7% as a baseline. They have pretty much done that on average over the last 10 years, bar 2023, where we do see that negative 9% drop, and hopefully this new deal that starts from September is something that can help them start to increase their top line. Total sales then, we have seen this, just another format here. Shares outstanding while returning excess cash to shareholders is when they do share buybacks. They have done that, so give credit to them. However, it has been very inconsistent and very minimal, so not something that we would talk about too much today. ROIC, now as always, 10% or more to give us faith management are able to effectively allocate their capital. What we do note, even though it has been decreasing over the last few years, even in the 20s or in the low 20%, it is still very strong, and that is a lot better than the typical minimums that we want to see of 8%. So that is a positive for this company, and as we said, that does make it very attractive for investors. Operating margin around 12%, well, they've straddled around that pretty much every single year, so there's a lot of inconsistency, so a little bit of a worry in my opinion, especially the trailing 12 month has dropped to 10%. Free cash flow margin, as we can see, pretty much a very similar story, straddling around that 5% level. Finally, the net debt to EBITDA, so the earnings before interest, tax, depreciation, amortization. Remember, these are the number of years it would take the company to pay off all of that debt net of cash on hand, and below 3 is our target. Now, while we use this metric, it does correlate to balance sheet strength, dividend safety, and 1.58 is good for 2023. It is meant to be marginally lower in 2024, so no worries with the dividend, you could argue, because it is below 3. However, when you incorporate the free cash flow payout being triple digits, not just in 2023, but also expected in 2024, for me, this is a red flag, something that I do personally worry about. And we will jump into the valuation model. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Multiples valuation model, now companies in a similar sector and size, average P multiplied by that of UPS. We get an intrinsic value showing some undervaluation, market value around 138, intrinsic value here 155. Just bear in mind we don't look at any of these models in isolation. We then have the yearly dividends over the period. Average growth rate is very nice, just disappointing. Their more recent increase was very low. Moving forwards, we've gone a little bit more conservative at 4%, given the average of over 12. This gives an intrinsic value showing undervaluation again, 170 as that value price. Then we move on to the DCF model. We have the free cash flow growth year on year. Average, as we can see, negative. It has been skewed by a lot of movement going from negative to positive. Forward looking, we have gone conservative below the analyst targets of 10 to 12%. With the discount rate, we get the present value of future free cash flows and terminal value, which we add together with the cash, subtract total debt, gets the equity value, divide by the shares outstanding, and as we can see here, a third and final undervaluation signal. Now, do bear in mind the intrinsic value in today's episode is the average of these three models, and it comes to $162. Don't forget you can grab a copy of this model by clicking on the pinned comment below, getting to both intrinsic value and acceptable buy price of companies in your own portfolio, as well as those on your watch list. So margin of safety at 10%, remember we execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that for this company, then it is above up to $146. Then we keep going till it's near the current trading price, and in today's episode, it is a buy with a margin of safety of 15% at that level, 137.90. So again, whether or not you believe it justifies that, that is what it's currently sitting at, so do let me know your thoughts below. And we do see Wall Street forecasting a price of around $165 over the next year, not too far off our intrinsic value, giving upside of around 20%. As always though, do let us know your thoughts below. Personally for me, there was a lot of red flags across this company, so this isn't one that I particularly will be looking to add to the portfolio. We had the inconsistently bottom line net income, so that was a bit of a worry. The margins weren't consistent, neither were the free cash flow, and that free cash flow payout in fact was very high, not just last year but also expected this year. So for me, this is one to avoid, but as always, I'm interested to hear your thoughts. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.